Central Bank of Nigeria, through a circular released on Friday, 13th October 2023, lifted forex restrictions on importation of 43 items. In 2015, the Apex Bank, in a bid to defend the naira from the weak crude oil market, decided to administratively reduce importation demand for US dollars from the nation's foreign exchange reserves. This is accomplished by banning 40 items from local foreign exchange markets. As a result, items like rice, tomatoes, vegetables, meat, margarine, cement, steel, metals, wires, and iron rods were marked as not valid for forex in Nigeria. 8 years after, the central bank, in a statement lifting the ban on the commodities, said it is committed to boosting liquidity in the nation's forex market by promoting orderliness and professional conduct among Nigeria's foreign exchange market participants. The Apex Bank also stated that it has set as one of its goals the attainment of a single foreign exchange market and will allow market forces determine exchange rates on willing buyers, willing sellers principle. What impact will this CBN's decision have on the nation's economy, especially with the current inflation rate and continuous fall of the naira at the international foreign exchange market? What could be the economic implication of the reserved forex ban on these 43 items? These and more we will be discussing on this week's special edition of Frontline, and we are in the office of Professor Mike Obada, the Professor of Economics and Chairman Goldmark Education Academy. Prof, you're welcome to Frontline.
Thank you very much.
And now let's start by knowing the actual reason or the cause that that led to CBN's forex ban on the importation of these items.
The reasons adduced at that time for the denial of access to the official foreign exchange market, to certain categories of importers are very clear. But before I explain the main reason, I want to say that the central bank actually did not ban the importation of any item or product into Nigeria. What the central bank actually did was to say there is a very acute shortage of foreign exchange, to finance all kinds of importation of goods and services. That the external reserve position was very low. As at June 2013, when this policy came on board, the stock of foreign exchange reserves of the country, that was just about a month after the Buhari government came into office, the stock of foreign reserves was just 28 billion, had declined from the previous year to 28 billion US dollars, even lower than the stock we have today that has created so much crisis, for the naira. So all that the central bank said was this, that Nigeria has the capacity to produce certain commodities in the country, including raw materials used for the production of goods and services, and therefore that there was the need to encourage local production of both goods and raw materials that were being imported into the country. A good number of the products actually had for a long time been produced. It's just that perhaps because of the negative impact of the oil booms, their production more or less ceased. So foreign exchange was very limited, 28 billion US dollars. And there was huge demand for foreign exchange for all kinds of importation of goods and services. People want to go abroad to study, education. They wanted money to go and take care of their health abroad, in addition to importation of all kinds of capital equipment into the country, and then raw materials. So the central bank said the quantity of foreign exchange available was very limited. Therefore, certain goods, raw material that could be produced within the country, should not have access to official foreign exchange market. But that the importers, if they so desired, can look to other segments of the foreign exchange market and buy foreign exchange and import the goods. So essentially, the major reason was to control the demand for foreign exchange, to conserve foreign exchange reserves, and to stimulate local production. And if that goal were to be achieved, then more people would have been employed, so unemployment would reduce, and then poverty would also reduce. So that was the laudable goal, as far as I'm concerned, of that policy.
And now that leads me to my next question.
Yes.
The aim behind this forex restriction, would you say it was achieved?
Well, to some extent. In Nigeria, the major tragedy of policy making is the apparent sabotage of such policies by vested interests. So invariably, I will say yes to a large extent, because as the policy was implemented, certain elements of import demand were controlled, and at the same time we had occasional improvement in the crude oil market, which is the major supplier of foreign exchange to the country. So external reserve position started growing. Up to 2 years ago, the country could boast of over $42.3 billion of foreign exchange reserves.
So, Prof, did this policy, did it in any way favor local manufacturers?
Which policy now? The denial of access or restriction?
The restriction,
Yeah,
did it in any way favor local manufacturers?
It was supposed to favor them.
Supposed to,
because manufacturers of certain products were expected to go into backward integration, invest in the production of certain raw materials that they could use in their factories. So it was a policy that was well intended. So if the policy didn't succeed in the area of local sourcing of raw materials or production, that was not the fault of the central bank. The fault of the manufacturers and other stakeholders in the economy that had their own objectives, quick money. Most people that say they are in manufacturing, they actually engage in importation of commercial products, buying and selling of goods and so on. So it was supposed to benefit them.
And so after 8 years, why is CBN lifting this forex ban?
Well, I want to see it as a strategy in the context of the current strategy of the government to liberalize the foreign exchange market, deregulate the foreign exchange market such that market forces of demand and supply would determine the exchange rate. So I think that's the major reason. The government's reasons are, well, they want to make monetary policy effective, if we have a unified foreign exchange market and so on, so that orderliness can prevail in the foreign exchange market. Not that you have the official market, you have the parallel market, And then before the unification of the exchange rate in June, you also had some, other exchange rates which central bank used to favor manufacturers of certain goods so that they could import the raw materials at lower cost. For example, small and medium enterprises.
And so for the common man,
Yes.
if you ask the common man on the street, they want to what they use to gauge, the quality of the economy is how strong, the naira is. So,
Yeah.
will this reversal now help the naira, recover from its weak state, that it's currently facing now?
Well, the government probably feels that it will help the naira, but my take on that is simply this: what has happened is that the government has now provided access, to the official foreign exchange market to all manners of importers, including importers of those 43 items. And so what is going to happen is this, that those importers that probably only patronize the parallel market and other autonomous sources of foreign exchange, they now can go and bid in the official foreign exchange market, along with all other importers, because the exchange rate there is still more favorable at perhaps about 700 naira, to the dollar. So you now have a situation whereby the importers of the previously, restricted products will now go and bid in the official market, but the stock of foreign exchange reserves available to sell to them is so limited, and that one, their needs cannot be satisfied by the central bank, and so they will still go to the parallel market to put pressure. So by their coming into the official market, what's going to happen, and indeed there are already signs of it, is that the exchange rate in the official market will shoot up. Up to last weekend or like a few days ago, it was a little above 700 naira to the dollar. I was, when I opened my phone this morning, I saw an online news report that the official exchange rate had moved to 800 and above, which means the naira is already depreciating in the official market. And that is exactly what is going to happen and what has been happening in the parallel market. As of yesterday, the exchange rate in the parallel market was 1,040, 1,050 naira to $1. So the official market cannot satisfy all the importers of goods and services. A large part of it will still go to the parallel market. And as the official exchange rate, depreciates, so also the parallel market rate depreciates. The parallel market operates like parallel lines. As the official rate moves up, the parallel market exchange rate also moves up, because the fundamental problem is not being addressed. And that fundamental problem is the problem of inadequate earnings of foreign currencies by the country. The country is not earning, any meaningful quantum of foreign exchange to beef up the foreign exchange reserve stock, so that when you and I or importers want foreign exchange, we are all, putting pressure on the small quantity available. It's free market, so the price goes up. So the basic issue here is that the current policy of providing access, lifting the restrictions, will not help the naira, because one of the reasons given is that it will improve liquidity in the foreign exchange market. That means it will lead to more foreign exchange being available for sale and buying in the foreign exchange market. That is kind of fast. It's not correct. because this policy now of lifting the restrictions is not a foreign exchange generating policy. What has happened is that you have unleashed those importers onto the official market. They want to buy dollar at any price, which they want to use to buy goods and services, or even export as capital flight, and so on. And so this policy will not help the naira in the foreign exchange market. It will not increase foreign exchange supply. What can increase the foreign exchange supply and help the naira is more production of exportable goods in the country. If we now have more agricultural products, more manufactured products being produced and then exported, then we earn foreign exchange. Or even if the nagging problem in the Niger Delta region, the phenomenon of oil theft, whereby every day between 400 and 500 barrels of crude oil, designed for export, are stolen. So if that problem is resolved, okay, I can guarantee you that more foreign exchange will come into the country. And, foreign exchange reserve stock, you will see it going up. When stakeholders, foreign investors, even domestic investors see the stock of foreign reserves going up, they will begin to have more confidence in the economy, believing that, when they want to, when they want to demand foreign exchange or get foreign exchange, they can easily get either through the official source, invariably through the official source, because if we now have more and the central bank begins to intervene more and more in the foreign exchange market through boosting liquidity, bringing in more supply, then you will see the exchange rate will begin to, appreciate. But the long-term, strategy would be, how does the country boost productivity in the economy? That is to say, output per person, which is at the present time very low compared to many other countries. If productivity is boosted, we are producing more and more, then we are able to sell them abroad, we earn. That's how China builds up its trillions of dollars of foreign exchange reserves. Whereas in Nigeria, we are talking about 33 billion dollars as of today.
And so, sir, in the long run, what does this portend for prices of some of these items? Are we going to see the prices skyrocket? Like, for instance, what is common to the average Nigerian, rice?
Yeah.
Are we going to see prices of those commodities like rice, rod, are they going to soar?
It's very likely, to the extent that the basic issue is not addressed. If there is no additional supply of foreign exchange to the market, and now many people believe that they can easily go to the central bank official market and buy foreign exchange, you see there will be a lot of pressure. So it's not likely, except the central bank, I don't know how it's going to do it, whether it's going to borrow money or whatever. NNPC said the other time that it was going to borrow $3 billion from the FRONTLINE Bank, African Export-Import Bank in Cairo, to support the naira. I'm not sure that one has materialized. Ordinarily, one does not even understand the local standing of NNPC in going to borrow money from international financial organizations to help the central bank. All one can assume there is perhaps the NNPC has local obligations that he wants to finance with naira. So if he borrows that one, it adds to the stock of foreign reserves. Central bank gives NNPC the naira. So invariably, that will still be, but the liability will still remain with the NNPC till it repays that loan. So if you have such assistance, such interventions that can boost supply of foreign exchange, we can expect, the naira to begin to appreciate. But then the government will also need to be cautious about, frivolous importation of all kinds of goods and services and capital flight, because some Nigerians are very ingenious. They get some of these foreign currency, and then rather than use the money to import what they are supposed to import, the money ends up going out of the country. So invariably, I don't want to say that I am so pessimistic about the current policy, but any favorable outcomes in terms of meeting the objectives of the central bank, improving local production, improving the effectiveness of monetary policy and all that, will depend on how we are able to mobilize foreign exchange for the official market and so on.
Okay, just a few days ago, the IMF expressed fears about Nigeria's currency and suggested that the federal government should seek dollar loan from the fund to stabilize the naira. Do you buy this IMF idea?
But unfortunately, by that statement, I read it, and the IMF seems to be speaking from both angles of his mouth. The same IMF is telling Nigeria that the debt burden as of now is too heavy, that Nigeria is spending over 90% of federal government revenue to service loans, both domestic and external loans. And the same IMF is recommending that the central bank and even the government should borrow money from it. They are working to actualize their self-interest. IMF, World Bank, they exist for the purpose of selling loans, debt to the developing countries. So if nobody is borrowing, Nigeria is doing well, earning foreign exchange, and it doesn't have need to borrow, many of their workers' jobs, will be gone. They will not have anything to do. They have offices in every country. All they are doing is use stratagems to encourage, the country to borrow money either from the IMF or from the World Bank. So invariably, Nigeria goes to borrow money from the IMF to boost, foreign exchange supply. But that will be temporary. Nigeria borrowed money from the Euro capital market, bonds, and also augmented, the foreign reserves at that time. But that was temporary. The impact, if Nigeria borrows from the IMF, will be temporary impact on foreign exchange reserves. So it can't really be a solution, because it becomes part of the public debt, which as of today is about 90 trillion. So borrows from the IMF. The World Bank also says that Nigeria should come and borrow. And the other day, the Minister of Works announced that the government had approved the rehabilitation of over 200 roads in different parts of the country, and that the government was going to utilize, China, Exim Bank loans. So you see, accumulation of loans at this early phase of the government's life is not actually in its interest, because what it means is that it's building up more and more public debt, and every year you must service those loans. Foreign loans, you still need foreign currency to service the loans. So I think the medium long-term strategy would be, how do we boost the exportation of goods and services from Nigeria? How do we address the oil theft problem so that we can quickly get money? If we address that one, I can assure you, we go a long way. Nigeria will be able to, achieve the IMF production quota. It was around 1.7, 1.8 million barrels per day, and Nigeria was producing on average of 1 million or 1.1 million barrels per day. I understand it has gone up to about 1.2 million barrels or so per day now. But the gap, it means that you still have over 500,000 barrels per day gap which Nigeria is not able to fill. Because of that, the OPEC has actually reduced the quota now to about 1.4 something million barrels per day. That's saying that Nigeria does not have the capacity to export and so on. So that if Nigeria begins to export more and more oil, and then earn foreign exchange, and then of course does not spend so much money, dollars, in importing refined petroleum products, that would be a very good blockage of a leakage. So Nigeria earns foreign exchange now from exporting oil. It still uses a large part, if not all of it, to import refined petroleum products. So the medium long-term strategies are boost oil production by checking oil theft, and then getting the local refineries to work, so that we will not be spending billions and billions of dollars in importing petrol. So I think the government knows what to do.
Thank you.
I think it's just the will, whether the will is there or not, that's the issue. Yes.
Many thanks, Professor Mike Obada. We've been discussing extensively on the nation's economy and providing solutions to addressing these salient issues. We thank you very much for joining us on this special edition of Frontline, and we hope to see you again next week for another exciting edition. On behalf of my producer and the crew, I say thank you for watching. Bye-bye.
Thank you very much.